In the early 17th century, the Netherlands entered a period of prosperity unlike anything the world had ever seen. Controlling major trade routes, dominating the seas, and actively supporting art and science, this small nation had become the economic heart of Europe. Yet, hidden beneath this wealth, the seeds of one of history's first major financial collapses were quietly taking root. And at the center of it all was neither gold nor silver, but a flower, the tulip. The tulip was not native to the Netherlands. It had been brought to Europe from the Ottoman Empire, and its elegance quickly captured the attention of the Dutch aristocracy. Rare varieties, especially those with unique colors and patterns, became powerful symbols of wealth and status. Over time, tulips were no longer just admired in gardens, they became financial assets. People began buying tulips not for their beauty, but for profit. At first, it seemed harmless. A rare tulip bulb would be purchased, cultivated, and later sold for a higher price. But as time passed, things began to change. Prices started rising rapidly, attracting more and more people into the market. Soon, tulip trading reached astonishing levels. Some bulbs became so valuable that they were worth more than what a skilled worker could earn in years. In extreme cases, a single tulip bulb could be exchanged for houses, land, and entire fortunes. At this point, tulips had transformed from simple flowers into purely speculative financial instruments. What made the situation even more extraordinary was that people began trading tulips without ever physically owning them. Contracts were created for future delivery, an early version of what we now know as futures markets. But there was a fundamental problem. These trades were no longer based on real value, but entirely on expectations. As prices kept rising, people believed they would continue to rise forever. More participants entered the market, pushing prices even higher. This self-reinforcing cycle was the classic formation of a financial bubble. Yet, at the time, no one wanted to believe it was a bubble. Everyone believed the profits would never end. And so, silently and steadily, one of the first great financial bubbles in history continued to grow. As the Tulip Mania grew, the market transformed into a frenzy that pulled in nearly every layer of society, not just the wealthy. Farmers, craftsmen, merchants, and even ordinary people who had never invested before didn't want to miss out on the opportunity. Everyone had the same idea in mind: buy today, sell tomorrow for more. One of the striking changes during this period was the transformation of where and how tulip trading took place. What had once been private exchanges in gardens or among collectors gradually moved into inns, taverns, and auction-like environments. These places effectively became the stock exchanges of the time. People gathered there to discuss prices, make deals, and dream of earning vast fortunes. But beneath the surface, the market was deeply fragile. Prices were no longer based on the true value of tulips, but on the imagined value people assigned to them. The price of a tulip bulb depended less on its beauty or rarity, and more on how much someone else was willing to pay for it. This made the entire system extremely dangerous. During this period, certain tulip varieties reached unbelievable prices. In particular, the so-called broken tulips, with their rare and striking patterns, were worth entire fortunes. What people didn't know at the time was that these patterns were actually caused by a virus. Instead, they saw them as miracles of nature and assigned them astronomical value. Things escalated even further. Some people began buying tulip bulbs that had not even been planted yet. In other words, trades were happening without any physical product existing at all. The market had become completely abstract. What was being traded was no longer a flower, but an expectation. Even more dangerously, people started borrowing money to participate in these trades. Investors, no longer satisfied with their own capital, took on increasing levels of risk in pursuit of greater profits. This multiplied the fragility of the system. because when prices eventually started to fall, repaying those debts would become nearly impossible. But at that moment, no one was thinking about a sakkot. Everyone believed prices would rise forever. This collective belief only inflated the bubble further. But as history has shown time and time again, no bubble grows forever. The year 1637 went down in history as the peak of the Tulip Mania. By then, prices had climbed to astronomical levels, and nearly every part of society was involved in the market. But one day, a turning point arrived, suddenly and unexpectedly. A sense of panic began to spread, and people rushed to convert their tulips into cash. At first, it seemed like a minor correction. Prices began to dip slightly, and some investors calmly chose to sell their bulbs. But the decline quickly turned into a chain reaction. As more people feared further losses, they rushed to sell, triggering a massive oversupply. What started as a small drop rapidly spiraled out of control. The collapse of the bubble was shockingly fast. Some of the rarest tulip bulbs lost nearly all their value in a single day. Bulbs that were once worth years of a worker's wages suddenly became almost worthless. People could no longer repay their debts. Some lost their entire life savings, while others stood on the brink of bankruptcy. A wave of shock and panic spread throughout society. The Tulip Mania was no longer just an economic crisis, it had become a social trauma. People were shaken both financially and emotionally, and trust within society was deeply damaged. For the first time, the dangers of financial speculation were revealed in such a dramatic way. Historians would later study this event as a powerful lesson, showing how financial bubbles, when driven purely by expectations of profit, can grow uncontrollably and collapse just as quickly. Tulip Mania became known as the first great financial bubble in history, frequently referenced in modern economics and finance. What happened during that time remains a unique example for understanding the risks of today's markets. But the postulations went beyond financial loss. Trust between people was broken, attitudes toward investment changed, and the Dutch economic mindset was shaped by this crisis for many years to come. For this reason, Tulip Mania is remembered not just as the story of a flower's rise in popularity, but as a lasting mark of human psychology and financial ambition in history. The collapse of the tulip bubble was not just an economic loss, it created a deep social trauma. Beyond losing their fortunes overnight, people experienced a breakdown of trust. Debts between neighbors, friends, and even family members became sources of tension. Some families lost their homes due to bankruptcy, and the crisis fundamentally changed how society viewed investment and speculation. Psychologically, Tulip Mania reshaped how people perceived risk. Many had become overly driven by greed as prices surged, abandoning rational judgment. This period is now considered an early example of what we call herd behavior and irrational investment. People based their decisions on what others were doing, and this collective mindset only accelerated the growth of the bubble. Tulip Mania also left a strong cultural impact. Artists and writers began to reflect the absurdity and tragedy of the time. Caricatures, satire, and stories captured the social consequences of the bubble. The extravagant lifestyles of the wealthy and their obsession with tulips became both a source of fascination and criticism among the public. In this way, Tulip Mania became part warning, part entertainment within Dutch culture. From a financial perspective, the crisis offered important lessons for the future. Banks and merchants began to better understand the risks of speculative bubbles. Investors, in turn, were forced to become more cautious. Tulip Mania was recorded as an early warning in the history of modern finance, and economists still study this period to better understand how bubbles form and how they collapse. Ultimately, Tulip Mania reveals how human nature and the balance of supply and demand play a critical role in financial systems. Psychological factors such as desire, fear, and expectation can sometimes override rational economic foundations. For this reason, the Tulip Mania, often considered the first financial bubble in history, is not just about a flower. It is a powerful example of the complex relationship between human psychology, social behavior, and economics.
The lessons left behind by Tulip Mania continue to resonate in the modern financial world, even centuries later. Today, bubbles in markets such as stocks, cryptocurrencies, and real estate are often built on the same foundations as tulips in 17th century Netherlands: expectation and psychology. As people chase rapid profits, markets risk becoming disconnected from their true value. Economists have long studied the tulip bubble to better understand how investor psychology and herd behavior influence market volatility. This event introduced the importance of rational analysis and risk management, serving as one of the earliest warnings about the dangers of speculative bubbles. Even today, Tulip Mania is frequently used as a case study in modern financial education. The crisis also provided critical lessons for governments and financial institutions. Regulators began to recognize the importance of market oversight and the need to protect investors. Even now, the lessons drawn from historical bubbles like this are used to understand and attempt to prevent future financial crises. From a societal perspective, Tulip Mania forced people to reflect on the balance between ambition and risk. One of the fundamental traits of human nature is the tendency to abandon rational judgment in the face of potential gain. Tulip Mania stands as a powerful historical example of this behavior, offering valuable insights for both historians and psychologists. In the end, Tulip Mania is not just a chapter in Dutch history, it is a universal lesson. What began as speculation around a simple flower revealed how deeply human psychology and social behavior can influence financial systems. For this reason, historians, economists, and investors continue to draw lessons from this extraordinary episode, striving to make more informed decisions in the present. Tulip Mania, remembered as the first great financial bubble in history, remains both a warning and a fascinating story that continues to captivate minds to this day.
Tulip Mania has become more than just a moment in Dutch history. It has evolved into a cultural icon. Artists, writers, and historians have explored this event not only as a financial collapse, but as a fascinating reflection of human nature and social behavior. Caricatures, stories, and paintings from the era mocked the speculative mindset while offering lessons for future generations. Some artworks depicted the wealthy proudly displaying their fortunes in tulip bulbs, while others captured the tragedy of loss and bankruptcy. Today, Tulip Mania is widely used as a teaching example in finance and economics. Students learn how bubbles form, how herd psychology influences markets, and how irrational investment behavior can lead to dramatic consequences. From cryptocurrency booms to the dot-com bubble, many modern financial manias are directly compared to this early example. This reinforces a timeless truth. History often repeats itself, and understanding the past is essential to navigating the future. Tulip Mania also continues to live on in media and popular culture. Documentaries, articles, and digital content presented as both an educational case and a captivating story. By studying this event, people learn to approach modern investments with greater caution and awareness. In this way, Tulip Mania has been passed down through generations as both a warning and a story that continues to inspire curiosity. Ultimately, this phenomenon reminds us of the powerful role psychological factors play in the world of investing. Beyond supply and demand, emotions such as excitement, greed, and fear are often the true forces that drive markets. Tulip Mania clearly reveals how human psychology and collective behavior can shape entire economic systems. From something as simple as a flower, humanity has drawn lessons that still guide decision-making in today's complex financial world. The legacy of Tulip Mania is still felt in today's financial world. Historians and economists continue to compare this event with modern investment trends, revealing the common dynamics behind financial bubbles. For example, the rapid rises and sudden crashes seen in cryptocurrency markets are driven by a psychology strikingly similar to that of 17th century tulip speculation. People are still influenced by herd behavior, often ignoring risks in pursuit of quick profits. In modern financial education, Tulip Mania is frequently used to teach key concepts such as risk management and portfolio diversification. Students learn how dangerous it can be to focus solely on potential gains without considering the downside. Bubbles serve as a unique laboratory for observing investor behavior and developing more rational strategies. Tulip Mania also helped shape the broader culture of investing. Over time, people became more aware of speculative risks and learned to approach financial decisions with greater caution. However, history shows that human psychology and social dynamics remain largely unchanged, which is why new bubbles continue to emerge. In this sense, Tulip Mania is not just a warning from the past, but an ongoing lesson for modern investors. Culturally, Tulip Mania has left a deep mark on Dutch history. The tulip is no longer just a flower, it has become a symbol of financial speculation and human ambition. This period is frequently explored in museums, books, and popular media, offering people a way to better understand the complex relationship between economics and human behavior. In conclusion, Tulip Mania, the first great financial bubble in history, is more than just the story of a flower. It stands as a unique lesson, revealing the complex interplay between human psychology, social behavior, and economics. The event vividly demonstrated how excessive greed, herd behavior, and speculative bubbles can drive markets to extreme and unsustainable heights. Even today, sudden rises and crashes in stock markets, cryptocurrencies, or real estate echo the same dynamics seen during Tulip Mania. Human desires, expectations, and fears have always played a decisive role in financial systems, and they continue to do so. For this reason, studying history is not only about understanding the past, it is essential for planning investment decisions with awareness and caution in the future. Tulip Mania has left a lasting mark on cultural memory, frequently referenced in art, literature, and education. By learning from this episode, people have improved financial literacy and gained insight into economic behaviors of society. What began as speculation around a single flower has endured for centuries as a symbol where economics, psychology, and culture intersect. Ultimately, Tulip Mania clearly illustrates one fundamental truth. In financial systems, value is not determined solely by material reality. It is shaped by human perception, desire, and collective behavior. This historical lesson remains vitally important for anyone navigating the modern world of investing. Thank you for watching our video. If you enjoy historical and financial stories like this, don't forget to subscribe to our channel. Make sure to like the video and share your thoughts in the comments. We'd love to hear from you.